The stock market is not random. It follows patterns that repeat over time. Understanding these patterns helps investors make smarter financial decisions. Every movement in the market reflects human emotions like fear and greed. To understand trends, you must first learn how markets actually behave. A stock market trend shows the general direction of price movement over time. There are three main types of trends: upward, downward, and sideways. An upward trend means prices are consistently rising over a period. A downward trend indicates that prices are steadily falling. A sideways trend shows the market moving within a stable range. Beginners often fail because they ignore these basic trend structures. Successful investors always study the direction before making any trade. Market trends are influenced by economic news, company performance, and global events. Even political changes can strongly affect stock market behavior. Supply and demand play the biggest role in the price movement. When demand increases, stock prices usually move higher. When supply increases, prices tend to drop in the market. Understanding this simple concept is key to reading trends correctly. Charts are the most powerful tools for analyzing stock market trends. A price chart visually shows how a stock moves over time. Traders use charts to identify patterns and predict future movement. Without charts, understanding market behavior becomes very difficult. Candlestick charts are especially popular among professional traders. Each candlestick represents price movement within a specific time period. These candles help reveal buyer and seller pressure in the market. Learning candlestick patterns is essential for trend analysis. Volume is another important factor in understanding stock trends. High trading volume usually confirms a strong market trend. Low volume often indicates weak or uncertain price movement. Combining price and volume gives deeper market insight. Trends do not move in straight lines, they move in waves. These waves create opportunities for investors to enter or exit trades. Identifying the start of a trend is highly valuable for profit. Many investors lose money by entering at the wrong time. Patience is crucial when learning how to read market trends. Emotional trading often leads to poor investment decisions. Fear can cause investors to sell too early in a rising market. Greed can cause them to hold stocks for too long. Successful traders control emotions and follow data instead. Market trends often repeat because human behavior does not change. History shows that patterns from the past often reappear again. This is why studying historical charts is extremely important. Trend analysis is not about guessing. It is about observation. The more you observe, the better your predictions become. Even experts continuously study market behavior to improve accuracy. Mastering the basics of trends is the first step to trading success. Identifying stock market trends starts with observing price direction carefully. The first step is to zoom out and look at the bigger picture. Short-term movements can be misleading if you ignore long-term trends. A strong trend becomes visible when prices move consistently in one direction. Uptrends are formed when higher highs and higher lows appear repeatedly. Downtrends are formed when lower highs and lower lows keep forming. These simple structures are the foundation of technical analysis. Traders use trend lines to visually connect price movements on charts. A trend line helps you see the direction of the market more clearly. When prices stay above a rising trend line, the market is strong. When prices fall below a trend line, the trend may be weakening. Support levels are areas where prices tend to stop falling. Resistance levels are areas where prices often stop rising. These levels help traders predict possible market reversals. Breakouts happen when prices move beyond support or resistance zones. A breakout often signals the beginning of a new trend. False breakouts can mislead beginners into wrong decisions. That is why confirmation is always important before acting. Moving averages are powerful tools for identifying trends. They smooth out price fluctuations to show the overall direction. A rising moving average suggests an uptrend is forming. A falling moving average suggests a downtrend is developing. When price stays above the moving average, bullish momentum is strong. When price stays below it, bearish pressure is increasing. Traders often use multiple moving averages for better accuracy. Crossovers between moving averages can signal trend changes. The golden cross indicates a potential upward trend. The death cross indicates a possible downward trend. These signals are widely used in technical trading strategies. However, no indicator works perfectly on its own. Successful analysis always combines multiple tools together. Volume confirmation is important when identifying real trends. A strong trend usually comes with increasing trading volume. Weak volume can indicate a lack of real market interest. Price action is another key method for trend identification. identification. It focuses only on raw price movement without indicators. Experienced traders rely heavily on price action patterns. Candlestick formations also reveal market sentiment clearly. Bullish patterns suggest buying pressure is increasing, and bearish patterns suggest selling pressure is dominating. Trend strength can be measured by its consistency over time. Strong trends rarely change direction without warning signs. Weak trends often fluctuate without clear direction. Learning to filter weak trends is essential for success. Proper trend identification improves decision making and reduces risk. To understand stock market trends, traders rely on technical indicators. These indicators help simplify complex price movements into readable signals. One of the most common tools is the relative strength index. The relative strength index shows whether a stock is overbought or oversold. When RSI is above 70, the stock may be overbought. When RSI is below 30, the stock may be oversold. This helps traders anticipate possible reversals in price direction. Another popular tool is the moving average convergence divergence. MACD helps identify changes in momentum within a trend. When MACD crosses above the signal line, it may indicate buying strength. When MACD crosses below, it may indicate selling pressure. Bollinger Bands are also widely used in trend analysis. They show volatility and potential price extremes in the market. When prices touch the upper band, the stock may be overextended. When prices touch the lower band, the stock may be undervalued. These bands expand and contract based on market volatility. Volume indicators help confirm whether a trend is strong or weak. High volume during a price rise confirms strong buyer interest. Low volume during movement may signal uncertainty in the trend. Stochastic oscillator is another tool used for momentum analysis. It compares closing prices to price ranges over time. This helps traders identify potential turning points in the market. No single indicator can guarantee accurate predictions. Combining multiple indicators improves the quality of analysis. Trend strength can be confirmed when several tools agree. Divergence between indicators and price can signal a reversal. For example, price rising while RSI falls may indicate weakness. This is called bearish divergence in technical analysis. Bullish divergence occurs when price falls but momentum rises. Understanding divergence helps traders spot hidden opportunities. Indicators work best when used with proper market context. Blindly following indicators can lead to false decisions. Experienced traders use indicators as supporting tools, not absolute answers. Chart patterns also work alongside technical indicators. Patterns like head and shoulders indicate possible reversals. Double tops and double bottoms also signal trend changes. Continuation patterns suggest that trends will likely continue. Flags and pennants are examples of continuation formations. Learning these patterns improves market prediction skills. Time frames also affect how indicators behave in the market. Short-term charts show quick movements and noise. Long-term charts provide clearer and stronger trend signals. Traders must choose the right time frame for their strategy. Combining indicators with patience leads to better decisions. Mastering these tools is essential for understanding market trends effectively. Understanding stock market trends is not only about charts and indicators. Human psychology plays a major role in shaping market movements. Every price change reflects collective emotions of millions of traders. Fear and greed are the two strongest forces in the stock market. When fear dominates, prices tend to fall rapidly. When greed dominates, prices often rise too quickly. Market bubbles are created when greed reaches extreme levels. Market crashes usually happen when fear spreads widely. Emotional reactions often create short-term volatility in trends. Rational thinking helps investors stay aligned with long-term trends. Many beginners panic when they see temporary market declines. Experienced investors understand that corrections are part of every trend. A correction is a temporary reversal within a larger trend. Corrections often provide new opportunities for smart investors. Herd mentality strongly influences stock market behavior. When people see others buying, they often follow without analysis. This behavior can inflate prices beyond real value. Eventually, the market corrects itself to realistic levels. Understanding crowd behavior helps in predicting trend shifts. Market sentiment shows the overall mood of investors. Positive sentiment usually supports upward trends. Negative sentiment often leads to downward pressure. News and media greatly influence investor psychology. Good news can push prices higher even in weak markets. Bad news can drag prices down even in strong markets, smart investors filter noise and focus on real data. Emotional control is a key skill in trading success. Impulsive decisions often result in financial losses. Patience allows investors to benefit from long-term trends. Discipline helps avoid reacting to every market movement. Confidence comes from understanding market behavior deeply. Fear of missing out often leads to poor entry points. Overconfidence can cause traders to ignore warning signals. Balance between fear and greed is essential for stability. Markets often move against the majority's expectations. This is why independent thinking is highly valuable. Trends develop slowly but change quickly. Under pressure, emotional cycles often repeat in every market phase. Learning psychology improves overall market understanding. Investors who master emotions tend to perform better long-term. Experience teaches traders how to stay calm during volatility. Emotional discipline is more important than perfect prediction. Successful trading is about managing behavior, not just charts. Understanding psychology adds depth to technical analysis. Market trends become clearer when human behavior is understood. Mastering stock market trends requires patience, practice, and continuous learning. No one becomes an expert in understanding markets overnight. Consistency in analysis leads to better long-term results. The first rule of success is never stop learning about the market. Markets are always changing, and strategies must adapt accordingly. What worked yesterday may not always work tomorrow. Keeping a flexible mindset is essential for every trader. Always analyze trends before making any investment decision. Avoid entering trades without a clear understanding of direction. Risk management is just as important as trend analysis. Protecting your capital should always be the top priority. Never risk more than you can afford to lose. Diversification helps reduce the impact of market volatility. Spreading investments across sectors can balance overall risk. A strong strategy combines both technical and fundamental analysis. Technical analysis focuses on charts and price movement. Fundamental analysis focuses on company performance and value. Combining both gives a clearer picture of market trends. Long-term investing benefits from understanding big market cycles. Short-term trading requires quick decision-making and discipline. Both approaches depend on recognizing market direction correctly. Staying updated with financial news improves market awareness. Economic indicators also influence stock market trends. Interest rates, inflation, and GDP all affect investor behavior. Global events can suddenly shift market direction. Staying informed helps you react wisely instead of emotionally. Practice analyzing charts regularly to build experience. The more charts you study, the better your understanding becomes. Learning from past mistakes is key to improvement. Even professional traders experience losses in the market. What matters is how quickly you learn and adjust. Successful traders treat losses as lessons, not failures. Confidence in trading comes from knowledge and experience. Avoid following tips blindly without proper analysis. Always verify information before making investment decisions. Developing your own strategy is more effective than copying others. Market trends reward discipline and punish emotional behavior. Staying calm during uncertainty leads to better outcomes. Focus on probability, not prediction. No one can predict the market with complete accuracy. The goal is to increase chances of success, not guarantee it. Over time, consistent analysis builds strong trading skills. Understanding trends gives you a powerful advantage in the market. Success in the stock market is a journey, not a destination. Mastering trends turns uncertainty into opportunity for growth.